In the span of just 6 weeks, over $1 trillion vanished from the cryptocurrency market. A staggering collapse that left investors scrambling for answers. While headlines pointed to the usual suspects, market sentiment, regulatory jitters, the real story, the one most people missed, was unfolding quietly in the backrooms of global finance. This isn't just another crypto crash. This is the story of a monumental shift in capital, a tectonic realignment of wealth that caught nearly everyone by surprise. What really caused Bitcoin's sudden downfall? The answer lies not within crypto, but in the rise of a new technological titan. The numbers were brutal. Bitcoin, once knocking on the door of $126,000, plunged to a 7-month low. Panic rippled through the market as headlines blared warnings of a crypto winter. Exchange-traded funds, the institutional gateway to Bitcoin, saw a mass exodus. Nearly $2.6 billion were pulled out in a matter of weeks, a clear signal that big money was heading for the exits. The charts, once a sea of green, turned into a waterfall of red. For the average retail investor, it was a bloodbath. But for the world's most sophisticated financial players, it was a calculated move. They weren't just selling, they were reallocating. As the crypto world bled, another sector was experiencing an unprecedented explosion of investment: artificial intelligence. Across the globe, a quiet revolution was taking place. Warehouses that once housed deafening rows of crypto mining rigs were being silently converted. The old hardware was stripped out, replaced by gleaming new server racks packed with powerful Nvidia GPUs, the very engines of the AI boom. Global investors, from sovereign wealth funds to venture capitalists, were systematically reducing their exposure to the volatile crypto market. They were chasing a new, more promising frontier. The capital that once fueled Bitcoin's meteoric rise was now being redirected, pouring into the burgeoning world of artificial intelligence. Then came the smoking gun, the move that confirmed the silent whisperings on trading floors around the world. SoftBank, the Japanese investment giant led by the visionary Masayoshi Son, made a stunning announcement. They had sold their entire $5.8 billion stake in Nvidia, the semiconductor company at the heart of the AI revolution. For a moment, the market was confused. Why would SoftBank exit one of the hottest stocks on the planet? The answer came swiftly. News reports confirmed that SoftBank was redirecting its capital, funneling billions into OpenAI, the company behind ChatGPT, at a valuation soaring towards $500 billion. The timeline was crystal clear. SoftBank cashed out of the AI hardware boom to invest directly into the AI application layer. This wasn't just a trade. It was a powerful statement. Big money was no longer just betting on the infrastructure of the future. It was going on a self-rearview mirror. This single move by SoftBank triggered a domino effect, cementing AI as the new gold rush of the 21st century. The narrative had shifted. Investors, once captivated by the promise of decentralized finance, were now mesmerized by the potential of artificial general intelligence. Capital began to flood into every corner of the AI ecosystem, from robotics and autonomous systems to neural networks and large language models. The valuations of AI companies skyrocketed, dwarfing the growth seen in almost any other sector. Market charts showed a clear divergence. As crypto stagnated, AI was absorbing global capital at an astonishing rate. It was no longer just a tech trend. AI was absorbing global capital at an astonishing rate. It was being hailed by the world's largest investment banks as the defining opportunity of the new decade. A force with the power to reshape every industry on Earth. So, how does this all connect back to Bitcoin's fall? It's a simple matter of liquidity. Imagine the global investment pool as a finite body of water. For years, a significant stream flowed into the crypto reservoir, pushing prices higher. But when a massive, more attractive opportunity like AI emerges, institutional investors act decisively. They reallocate. They divert that stream of capital. When giants like SoftBank move billions of dollars out of one asset class and into another, it creates a vacuum. The upward momentum that Bitcoin relied on from institutional inflows suddenly vanished. It wasn't that investors suddenly lost faith in Bitcoin's long-term vision. It was that they saw a more immediate, explosive growth opportunity elsewhere. The capital rotation from crypto to AI was the primary catalyst, the hidden force that pulled the rug out from under the market. Of course, other factors were at play, creating the perfect storm. The Federal Reserve's persistent refusal to cut interest rates kept borrowing costs high, discouraging speculative investments. A broader risk-off sentiment swept across global markets as geopolitical tensions and economic uncertainty led investors to seek safer havens than volatile digital assets. And the ever-present shadow of regulatory crackdowns in key markets continued to weigh on sentiment. These supporting factors amplified the effect of the capital rotation, turning what might have been a minor correction into a major market downturn. They were the headwinds that exacerbated the pain, but the engine failure was the massive capital flight toward AI as the dust settles. The crypto market is finding a new equilibrium. The charts are stabilizing, and when you zoom out, Bitcoin's long-term trajectory still shows remarkable resilience. This isn't the end for cryptocurrency. Its core value proposition as a decentralized store of value and a new financial rail remains intact. But the landscape has fundamentally changed. The rise of AI represents a new paradigm, a competing center of gravity for global capital and innovation. The question that remains is whether this is a temporary rotation, a short-term fling with a new shiny object, or the dawn of a new financial era where AI reigns supreme and crypto must learn to coexist in its shadow. The next few years will define the future of both. To continue following these deep dive investment trends, subscribe for our next analysis.